G'day everyone, welcome back to the Real Wealth Podcast. We're back after a busy June. Welcome, Stefan, Angelini.
Yeah, we're back.
And back today to talk about investing for your kids' future. Principally why? Well, the why is twofold, because it'd be a wonderful feeling down the line to be able to hand off a gift to your kids and say, look, I saved diligently, I planned ahead, and here is something. But also the why incorporates the different financial vehicles that you can use to do so. So on that, we're going to talk today just a bit of a forecasting what we're going to chat about: savings account versus share portfolio against property, and finally investment bond. So their advantages, disadvantages. But before we do that, do you want to cover off the disclaimer?
Hey guys, Stefan here. Just letting you know this is all just general advice. Please don't consider it as personal advice. And if you want any personal advice, go and consult your licensed financial advisor. We're going to talk about structures, tax structures. We won't talk about specific investments. And cash and savings isn't actually considered an investment anymore.
Really?
No, it's just a savings vehicle. So
okay.
Yeah, we don't have to write advice on it, which is not.
I see.
We used to have to.
It's the classification of,
which is a pain in the backside.
Yeah, very good.
Good stuff. All right. So
first off, so when it comes to investing for your kids' future, a lot of people would default to, without much of a plan, just savings account. Is that fair to say? I'm just squirreling money away. I'm just putting money away.
That's where they'll go. Yeah, it's easy that way. So that is the default, and that's what my parents did, and that's what my grandparents did. And if you look at back in the day when they actually did that, interest rates were a lot higher.
Yeah.
So if you ever heard of someone that was born in the 60s talk about their interest rates when they bought their first house, they'll tell you about just how high the interest rates were. You had 18%, 21%. Now you could imagine that if interest rates on home loans were that high, then you could get quite a lot of interest on your savings accounts. So if you were just putting money away for the next generation because you had no debt on your home, and that was getting 15%, well, that's a great return for taking 15%. Yeah, well, over time, that's where it was.
Yeah.
So if you look at the graph of where interest rates have come, and that's where you get your interest in your savings is sort of pegged to where the Reserve Bank have their cash rate. Yep. At the moment, it's 4.1%. Yep. So that's why you're seeing these high interest savings account at 4.5%. They're floating around.
Yeah.
But now things changed.
Yeah.
So over the last 10, 12 years, interest rates have come right down to barely nothing.
Yeah.
People have been up in arms because it's increased to 4.1%, but it was there 10 years ago.
Yeah, okay.
So now you're getting okay savings rates, nothing like it used to be, but still it's not a better return than if you were in other markets long term.
Yeah.
But what is it? Safe.
Yeah, okay.
Not volatile.
Low risk, low reward.
Yeah. Yeah. That's it. So if you want to put money away for your kids, you just want to make sure they actually get it.
Yeah.
And that might be the best option.
Yeah. Guarantee they're getting a modest amount rather than risking it for a greater amount.
Yeah, exactly right. And that sort of comes to the position of, if you've got a home loan, if you're normally you have kids, and a lot of people have a home loan and they have an offset account.
Yep.
And if you go, right, I'm going to put money in savings for my kids, and that savings account is going to earn 3%, and then you're going to pay tax on that 3%.
Yep.
Or do I put it in my mortgage account or offset account, and it's going to offset my loan, which I'm paying 5% on?
Oh, yeah.
So you're saving 5% versus earning 3%. The issue with earning 3% is you pay tax on that 3%.
Yeah.
Pay tax at your marginal tax rate, unless you've got it in the kid's name. And then how much can your kids earn? This is where kids' tax rates come into effect. So a kid can only earn up to $416 a year before they start getting taxed.
Kid as in 18, under 18.
Under 18, yeah. So they can start getting taxed pretty heftily. And then after $1,000 or so, it comes down to like 47. So 47%. So it's not advantageous to give your kids heaps of money. Yeah, that's right. Yeah.
Yeah, okay.
And not if they're making a lot of interest.
Yeah.
If it's just a little bit, it's all right.
So does that mean, in summary, probably not a bad call from your parents and your grandparents, given the context, given the interest rate at the time? However, current climate, not your best option.
Yeah.
Safest maybe, but not best.
Safest. And if that's your personality, you just want safety.
Yep.
Then great.
Yep.
Awesome.
So that leads us to another option that would be looked at by a lot of parents wanting to save for their kids is investing in shares. So take that money rather than just sit in a savings account. Let's invest it a little bit more aggressively. Take on higher risk, higher reward. So how does that sort of play out?
It's all about whose name it goes into. So the issues of holding it, who earns the dividends. So first off, how do you get the money to your kid? So it's all good to earn a return, but how do you get the money to your kid? Do you have the asset in their name?
Yep.
Do you have the asset in your name? Who earns the dividends on it? So if you declare dividends in your tax return, then technically it's your asset, even if you've got trust of your kids. Where if you say the kids earn the dividends, then it can be the kids, you can give them the shares in the long term. But let's say that you own a stock or an index and you hold it for 20 years and you say it's on behalf of your kid, but you declare the dividends in your tax return. Do you want the franking credits? And then you got to transfer it to your kid, it's probably going to have a capital gain event.
Okay.
So
as opposed to setting it up in their name in the first place.
Yeah. So if you buy a specific stock for say $10, it goes to $30, and you've got a capital gain event of $20 on the individual on the stock. You could be in a lot of strife when it comes time to transfer.
So the kid's going to inherit the shares. The kid's also going to inherit the CGT.
Well, the parent has to pay the tax.
Oh, okay.
On their
So
tax
the
return.
it, right.
Yeah, and like the ATO will catch you out. Yeah, eventually, because when you do a name transfer, it's change of ownership.
Yeah.
So unless you can prove it's always been the beneficial, the kid has always been the beneficial owner. They've always had the entitlement to it. Then you're all right. Otherwise, it's tough, but you can get decent returns. So
better returns than simple cash account.
Yeah. So we look at. I'll give you an example. What's an index fund we can use?
ASX 200.
ASX 200. So top 200 companies in Australia, weighted by market cap. Pretty easy investment. Their index funds are around a lot now. There's a lot of different companies that do them. Simple stat that if you were to put away $500 a month from 1990 to the year 2020, then you would have put away 180 grand. That'd be worth $700,000 now.
Gee.
So average rate of return of 7 to 8% per year over the last 30 years. Yeah. And that's where you get those amplified returns compared to where savings is right now. Is it risky? Yes. Is it volatile? Yes.
Yeah.
But those numbers I gave you are based on that per year average over time. So you might have 1 year it's up 20%, 1 year it's down 10%, 1 year it's up 3%, next year it's down 2%, then it's up 10%. You average it out, it's averaged about 7 to 8%.
Okay.
On average per year.
Do you mitigate that risk by investing? Because that's a relatively long period of time. That's 30 years. Do you mitigate that risk by parking the money there plus your regular contributions for that period of time? So you have a market downturn, but if you're in it for 30 years, you're going to bounce back.
That's it. Yeah. Because you go with the market cycles. And that's the thing. So and Vanguard have amazing charts on this, that if you invested, 10 grand today or $500 a month, and you just stayed invested, you just kept going, you didn't change your strategy at all, you didn't pull money out, where would your money be? And that's where I got those numbers from.
Okay.
So not wavering from the strategy, just putting it away.
Yeah.
But it's a great little thing. So the next one is if you invested, as I said, 10 grand. So if you start with 10 grand, when it comes to investing, if you can start with a higher lump sum, you've got the benefit of compounded returns over time. So if you were to invest 10 grand for a kid in 1990.
Is this without the regular top up contributions, just 10 grand flat?
It is 10 grand flat. Yep. That would have grown to $94,000.
Over the same time period, 1990 to 2020.
Yeah.
Okay.
Yeah, I think so.
Significant when you compare that against the cash account.
Yeah, that's right. So you can make returns, right? But if you're holding there for 30 years, you can see there's a big difference. But then if you've got 10 grand that turns into 94, and then you got to give that $94,000 to the kid, you either sell the shares or you transfer the shares and say you deal with it now. Someone's going to pay tax on that $84,000 because the government's not going to let you walk away.
It's a backhanded present.
Yeah, it's the ATO is going to go, well, someone's made money here. Yeah. Someone's made money. Yeah. That means someone owes us money. Who's going to give it to me? And it's probably going to be you as a parent not wanting to make your kid pay the tax on it.
Yeah.
Or if you've got to pay tax on it, let's say you're on the highest marginal tax rate, take 23% away from that gain. So $84,000, let's say you're going to pay 20 grand in taxes. Your kid's only getting $74,000 out of the total 94 it would have become.
Yeah.
So it's a 20 grand hit. Means your average return isn't that great.
Yeah. So it's worth considering when you set it up, when you invest in the beginning.
Yeah.
How is this going to play out?
Yeah, exactly right. So you've got to focus on that long term. When it's for the kids' benefit, what's it for? Am I going to give them the money? Is it going to go towards education? Either way, whatever it's for, there's going to be a tax event when you try and get access to that money.
Yeah.
So how do you plan for that? And most of us, as time goes on, we make more money, and therefore our tax rate is going to be higher as we get older and earn more money. And that's when you diminish a lot of the returns you've got when you pay tax.
So what about a scenario where someone looks at that and goes, do you know what, too hard, I don't want to try to read the market. Let's just go property. And then in time you hand over the property or you sell it and you hand over the gift to the kids.
It's a tough one. What happens with property when you want to buy property? There's two people that want their money. The State Revenue Office wants stamp duty.
Yep.
And if you sell a property, the ATO, and it's not your home, the ATO wants their capital gains tax because that's where they get their revenue. Revenue number one is tax, and number two is stamp duty. So they're going to try and get it no matter what. And that we get a lot of questions saying, "Oh, I want to buy a property for my kids, keep it there because it's going to be so hard for them to enter the property market because property prices keep going up."
Yep.
Since 1970, properties doubled every 10 years. Well done to the Italian migrants that came here and started buying property.
Just self pat on the back there for your community.
That's just what they did. It's like, oh, well, we won't buy anything else. We'll just buy property.
Yeah.
Okay. Save, and buy.
Yeah.
And, it's been a really great asset class. And now people are getting worried their kids aren't going to be able to afford a home.
Makes sense in theory. I'll buy it now because it'd be so much cheaper than them trying to buy it in the future.
Yeah. Yeah. But what do you need to buy property now? You need a heap of cash.
Yep.
And if you haven't got a heap of cash to buy the property outright, you take on debt.
Yep.
It's not going to be a home. So it's going to be in class as an investment. So that means you've got to then maintain that property. And if you're borrowing a heap of debt at the moment, you're going to have a negative cash flow, most likely on the property. And therefore you're forking money into it to maintain this thing for your kids' future. That's fine. Like it's a regular investment plan. Awesome. You want the asset to then go up. But then what happens on the transfer?
Someone owes someone some money.
Someone's going to owe someone some money. That's right. So you've got if you own in individual names, and that's, when you've got a property.
The parent.
The parent, yeah. So let's say me and you were a couple. We own the property in joint names, lucky me.
Yeah.
We own the property in joint names, and then we transfer that to the kid.
Yep.
SRO is going to go complete change of ownership.
Yeah.
It was never for the entitlement of the kid. How are you going to prove it was?
Yeah.
We want your kid to pay stamp duty on this transfer. Okay, that's fine. What about capital gains? Yeah, no, we're going to ask for capital gains too because, it's gone from you bought it for $500,000, it's worth $1 million now.
Yeah.
You can't just get away from that. But then we go, all right, so how do we try and negate at least one of them? So we say if it's always going to be classed as an investment asset, and you can't put it in your kid's name because they can't get the lending, they can't be the owner, they're going to earn too much money, all that kind of stuff. Why don't we put it in a trust? And what's the benefits of the trust? Well, you can prove who the end beneficial owner is going to be. And if you can prove who the end beneficial owner is going to be and who it's always held in benefit for, then you can sometimes, as long as you tick all the right boxes, you can get around stamp duty, paying stamp duty again. You can say, well, this property was bought for that person, always for that person. So if it ever has to get transferred out to become a principal place of residence, you may be able to get away from paying that extra stamp duty again.
So the trust structure allows you to establish from the beginning who it was designated for. It was always going to be for these people.
Yeah, exactly right. So look, there's a lot of advice you've got to get around it and how to prove it, but there are specific sections in the Land Duties Act that specifically explains if it's for this purpose and it goes to this person, don't worry about paying stamp duty. And that's where we sort of, but what's the other thing they want? The ATO. The ATO wants some money. So if the ATO want capital gains, what do you think? If I own the asset, it's always been for this person. We're now transferring the property to that person. We're paying capital gains. We're paying capital gains. The ATO, they'll go, that's cool. SRO don't care. That's fine. That's my ugly sister. We want our money. So the ATO is going to ask for their tax. So if you go, right, all right, I've held this asset for 20 years. It might have gone up. Let's say it's gone up double. You bought it for 500. It's worth $1 million. 250 grand of that is going to go directly onto your tax return. You get a 50% discount. You get to determine who actually gets the tax bill because it's owned through a trust. You get to determine who gets the tax bill. So then someone's going to have to foot the bill.
So there's wiggle room on the stamp duty, but CGT is guaranteed. Okay.
And the property's still got debt. You're changing ownership. The bank's going to go, who's going to take over the debt? Can you prove this person can service that debt? So it creates complexities down the track. It's a great strategy.
But you've got to be aware of what you're getting into. It sounds like you've got to know how to set it up in the beginning and what's going to happen at the end when you transfer, when you sell.
Yeah, that's right. Because it's all good to have a fantastic idea. But when it comes time to exit and you then hit a brick wall and you go, this is all too hard. Why do I do this in the end? And that's where a lot of people get to because they haven't done all the planning at the start. So lo and behold, the title of being a financial planner is, well, how are we going to plan for that exit?
Yeah.
What's our strategy to get out?
Yeah. Okay.
Anyway, so a lot of people don't end up buying property for the
Everything
benefit of
you
their
just
kid.
talked about, yeah.
But it's like, but if you buy it and you own it and then you die and your kid gets the property, different situation.
Yeah.
So that's a
harder to factor in the old death.
Yeah, well, that's, you just hold the asset forever.
Yeah.
Do you ever want to sell it? No. Great.
Okay. Yeah. Good strategy. So what about one that we talk to a lot of clients about, particularly when it comes to, I want to have something to hand over to my kids. One that we discuss is investment bond, which is all often met with, well, what the hell is that?
So investment bond has been, it's becoming more popular. And so you got, if I'm going to invest in my personal name, people say, well, it's for my kids, like it's for my kids' benefit. I don't want to pay tax on it. I don't want to have to deal with the transfer at the end of the day. You got these special structures called an investment bond, which now they lodge their own tax return. So it's your investment, but it's not in your name. It's for an end benefit of, I'd say, a kid. There's special kinds of investment bonds called education bonds where, so these bonds pay tax internal over time, a lower tax rate, and then you can get the tax back if you meet certain criteria under an education bond. But if you hold these investment bonds for a certain period of time, when you go to pull the money out, well, I spoke before about if you own a share, it goes up in value, you transfer the money to your kid, you're going to pay capital gains tax. Under these investment bonds, it's a tax-paid structure. So when you pull the money out, you don't pay capital gains tax. In some cases, you might actually get a discount on the tax when you pull it out, depending on when you do it. So you pay a lower tax rate internal rather than your personal tax rate. You get it out, you can pull it out capital gains tax free. And if you, as I said before, normally you earn more money as you get older. Because you become better at what you do. And therefore, there's less tax benefits on exit. Sorry, there's more tax benefits on exit. And you can still invest your money. So it's not just going with the savings.
Through the vehicle of the investment bond.
Okay. And the question we always get is, well, what's it invested into? The answer is you can invest into it just like your super's invested. For example, there's a few other benefits of these structures, like estate planning. So it's a non-estate asset. And what that means is it doesn't go into your will. If you said it's for your kids' benefit, but then you split from your partner and their ex-husband wants access to that bond, say, no, it doesn't form part of my estate if I die, it's for my kids. So it negates any kind of legalities to do with that because you've got an end beneficiary there. So there's a few other cool things about it, but the real crux of it is it's invested, making long-term returns, and it's an easy tax situation you don't have to worry about. And the tax at the end of the day is not going to be an issue. So that's why it's growing in popularity.
And you've established from the beginning who it's designated for, what the purpose of it is in a way that can't be contested, and you can invest in the meantime. Over that period of, like the numbers we ran before, potentially 30 years.
Potentially 30 years, So let's run some numbers.
Let's
run some numbers. So you got your computer there. So we're going to show you just quickly if you were to invest, start with 10 grand. I'm going to put 10 grand into a savings account. I'm going to put in $100 a month. For 20 years. And the effective compounded return, so the money growing on itself. So put in a return rate, say average of 3% savings rate.
3%, cool.
So the money keeps earning money on itself. So what does it come out as?
So initial deposit 10 grand, regular deposits we chipped in 24,000, and
you would have made 17 on that.
For a total of 51.
So your 34 grand invested over 20 years becomes 51. It's cool. What about if you made a 5% return? So there's 5% return, you might save a more defensive investment portfolio. Got some bonds in there.
So we're now looking at 68,000.
All right. So
10,000 initial investment with regular deposits of 24,000.
So instead of your 34 becoming 51, your 34 grand investment becomes 68 grand. That's pretty good. What about 7% return? So if you look at a 7% return, your 34 grand becomes $92,000. And that's so it doesn't go up by the same amount. If you're making that 7% per year, you're making 7% on the 7% on the 7%. So that's why it amplifies your end result. And that's where a lot of people say, why don't we start investing as soon as possible? And why don't we take money put in extra money if we can to enable that to grow further.
So what did we just run? 3, 5, and 7%.
3, 5, and 7.
Roughly 51, 68,000, 92,000.
That's right.
Yeah.
Yeah. So what was it? So the first difference was 17 grand.
Mm.
And then the next difference was 92 takes 68
24.
is 24. So you can see it starts to grow.
It's worth
a little bit.
it's worth stretching at the beginning, get as much in as you can in the beginning.
Yeah. But if you didn't start with 10 grand, it'd be a lot lower.
Yeah.
Your end return would be a lot
Yeah.
lower. So start with higher every amount if you can. And what are the main takeouts we can give people from this for investing for your kids' future?
Know what you're getting into in the beginning, plan for what's going to happen at the end. The only other one would be, do you want to pick a favorite out of what we've discussed? Or is it horses for courses?
Can't pick a favorite. That'd be giving financial advice. Everyone's different.
That was a test. You passed.
Know your risk profile. Understand the exit and what's going to happen when you want to eventually give the money to your kid. And understand do you want to take risk and try and target a higher rate of return for your kids? And therefore, you can pick what's going to be the best way to grow that investment portfolio for your kids' future.
Very good.
Good stuff. All right, Tommy, we're done.
All right. Good to be back. We'll see you again soon.
Thanks all for listening. See ya.
Cheers.
Bye.